What's going on, everybody? Spencer from Great Capital. And, everyone's talking about inflation every single day. If you're watching the news, reading your feeds, you're seeing all kinds of different stories and opinions about inflation, whether that's in the price of lumber, the price of commodities, single-family homes increasing, or you're just tracking the Federal Reserve, the Federal Open Market Committee, and what they're saying on where they think inflation is going. It's got a lot of people asking a lot of really good questions. But first, if you're not subscribed to this YouTube channel, the Great Capital channel, make sure you do that right now. Give this video a like. And again, to take the next step, hop on over to grayreport.com to get all updated information, research reports on the multifamily industry. And if you'd like to take the even further, deeper step, hop on over to graycapitalllc.com, learn about investment opportunities and all kinds of stuff about Great Capital. All right, so let's get into talking about inflation and what you can do about it. So first, what is inflation? And, I'm not an economist, and this isn't a video dedicated to understanding the definition of inflation, but, in general, inflation is when the prices of things go up and really the value of the currency or the dollar decreases in relation to goods, services, and materials. So, whether that is, going to get a, gallon of milk, or you're going to, buy a 2x4 or buy a house, what are those prices in relationship to the currency? In our case, we're talking about the US dollar. But there's different kinds of inflation, and that's been the big debate of recent. During the coronavirus pandemic, we had a huge deflationary pressure that decreased the prices of many things. The stock market, some commodities briefly. We had oil that some futures went negative for a brief period of time. And so that's much more of a deflationary pressure when the value of goods really goes down. And then we have reflation, which is what we've experienced, in 2020. And it's begged the question of how much of this inflation are we seeing is actually reflation? And reflation is essentially making up lost ground that has been caused from declines from previous economic events. Again, so when the price of oil, was down, sub $20, again, those future contracts went negative. Well, that the price increases going back to more normalcy, that's not necessarily inflation. We're just reflating and getting back to where we wanted to go. So if we were, growing, if anything was growing by, say, 2%, and we saw a 4% decline, which would be, basically negative 2%. Well, if we had a 3% gain from that negative 2%, we'd be growing at 1%, which you would say from the base effect, we'd be growing at 3%, which would be a large growth, but we still haven't even gotten back to that 2% number that we were targeting. And, in general, the Federal Reserve, they shoot for a target inflation of around 2%. In previous years, that target was specifically, they wanted to hit 2%, and they didn't want to overshoot it, but that's changed in recent months, where they're now targeting an average of 2%. So we can go over 2%, or we can go below it, but over time, over a given period, which no one knows what that period is, but we want to shoot for an average of 2%. So if we're at that 2%, that's kind of a healthy inflation. You want a little bit of inflation in the economy. You want to see the prices of goods growing to a certain extent, but you don't want to get too much growth where things get out of whack and imbalance, which is a little bit of what we're seeing today. And that begs the question of, are we seeing more of a transitory spike in inflation, which is essentially a shorter term blip and gap up in the prices, increasing of certain goods, certain commodities, certain services? Is that going to be a short-term scenario where then growth is going to level back off closer to that 2% mark? Or are we approaching a level of, maybe not full hyperinflation, but elevated rates of inflation, where we're really going to be operating over that 2% inflation mark for an extended period of time, which we really haven't seen since the 70s and 80s. In fact, we've actually been in a more deflationary environment the past few decades. A lot of economists, a lot of investors were assuming inflation was going to take place after the 2008 great financial crisis, when significant amount of money was printed, quantitative easing was going on, but we never really saw inflation take off. That was because of all the deflationary effects from technology, as well as demographic changes as the population gets older. So even though there can be price pressure, there are other factors that go into the formula that, even though the money supply may be growing, those deflationary pressures can offset that. And that's what's happened essentially over the last decade or so. But now in 2021, we've seen over $6 trillion being printed, and we had a once in a 100-year event that was the coronavirus pandemic that really it shifted a lot of things around. People were moving, a lot of strange economic activity took place. Things were shut down, things were turned off, and a lot of things are out of balance. A lot of supply squeezes, supply pressures, whether that's from plants being shut down, shipping lanes being delayed, or just, where situations where you couldn't actually work at that factory or at that lumber mill or at that, meat processing facility. So the supply decreased, but that demand was still there. In some cases, demand increased in case of single family homes, or, like RVs and other products, but they weren't making enough of them, causing a spike in prices. Okay, so all this is going on. Obviously, we're seeing some degree of inflation. No one is even arguing that. Again, it's not a question of if inflation is here. The question is for how long and how much. Is it transitory or is it going to be more long-standing? But regardless, what do you do about it? Unfortunately, the best time to do something to protect yourself against inflation is before inflation shows up. So really that was yesterday, last month, last year, 5 years ago. If you could be allocating to certain investments, certain types of assets, you would have had some shelter, some protection from inflation. And it's not that you're going to be insulated or if these investments are completely uncorrelated, they're decoupled from the dollar and inflation. It's more that they track inflation or they outpace inflation. They can kind of skip along on top of inflation and usually perform better compared to other assets or other investments. Because the fact is, inflation, it's volatile and it's uneven and it can be a little bit unpredictable. It's not one thing that causes inflation. It's usually a combination of multiple factors that add together to cause price pressure over time. And because of this unevenness and because of this volatility, it's important to allocate yourself to assets, to investments that, again, they can track this, that can go along with the volatility, and then they can reprice themselves. They're not latched to dollars of 2020. They can reprice for dollars of 2021, 2022, and continue to match the pace, if not exceed the pace of inflation. So what are some good investments in these assets? We've been talking about it, but what should you do? There's really, two main asset classes that perform the best during inflationary times. There's also a handful of kind of ancillary options. And then there's a few that you might want to avoid during an inflationary environment. The two main hedges against inflation that everyone should consider are commodities and real estate. Now, there are different benefits and advantages of either, and depending on what your own goals and what your motivations are, one may be better for you, but really looking at a combination probably makes a lot of sense for most investors. Commodities are the inputs to create all these consumer goods that lead to services, and as individuals buy these commodities, they're traded every single day across the world, whether it's gold, whether it's copper, whether it's silver, whether that's oil, soybeans, corn, anything, any raw good is typically a commodity. And that there are these large open markets for these commodities. So you're getting a high level of liquidity and price discovery every single day that can continue to track wherever the value of the dollar is, the value of any currency related to that specific commodity. So, for example, if you're allocated to, gold, whether that's physical gold or a gold ETF, or whether that's crude oil, whether you've got a, barrel of oil sitting in your garage, which don't do that, or you are owning a, a U.S. oil ETF, regardless of the vehicle itself, as the price of that commodity increases in one of the, open markets, that price, you're going to be able to keep up and track it based on your ownership of that commodity. Now, real estate is it's a physical asset like commodities, but it has a couple different benefits and I think a couple advantages over some commodities. The first one is it's cash flow. Gold, oil. So, unless you really own an oil well somewhere, you're not going to be receiving cash flow and income from your investment. Your entire investment thesis and the value is really tied to the underlying value of that commodity or that asset itself. Whereas real estate, specifically, income producing real estate that we like to talk about, it's actually producing cash flow on a, typically monthly basis. As tenants pay their rent, that goes to the landlord and usually puts money into your pocket. So not only do you have the value of the physical thing, the real estate that is pretty supply constrained, it is throwing off cash. And that brings up a good point because there are different types of real estate, different asset classes that perform a little bit better. We talk a lot about multifamily apartments here, but there's also, industrial assets, office buildings, retail, hotels, a whole host of different types of commercial real estate you can invest in. We really like multifamily apartments as a great hedge against inflation because you are constantly re-signing new leases, which can track inflation. So if the value of the dollar decreases one day, or if the price of rents are increasing, you don't have to wait, the next year to reset your rent levels at where the market rate is. You can reset those market rents the next day for new leases. Obviously, you have leases that were signed previously that have to expire before you can reset those leases. But when you're looking at a large apartment community, maybe it's 150 units, maybe it's 200, maybe it's 400 units, you are signing new leases, hopefully on a near daily basis. Therefore, you can track inflation or hopefully exceed inflation every single day. Now, that's different compared to like an office lease where you may be signing a 5 to 10 year office lease. There's usually rent escalations built into those leases. So, after, 3 or 5 years, you're going to be paying a couple more dollars per square foot. But again, those are written into the lease based on, $2020 or whenever that lease was signed. And so if market leases have increased significantly, if inflation has picked up, you're no longer tracking inflation because you have to wait at least, and if not for that lease to expire in 5 years, you still may have a 10-year commitment that has rent escalations that are far below the current rate of inflation. So while the underlying investment itself, like an industrial property, may be appreciating significantly because there's so much investor demand for industrial properties like there are right now, the income from those industrial properties may not perform as well in an inflationary environment compared to multifamily apartments. And then like hotels, which are, they're renting out, they're, booking rooms every single day, which could be a great way to track inflation. The only problem with hotels and hospitality is that they're much more correlated to the broader economy, and as the economy dips, hotel revenue can dip as well. So not that it can't track inflation, you're just adding a little bit more volatility and risk to the equation. So we've talked about commodities, we've talked about real estate and different types of commercial real estate asset classes, but there's another asset class in investment option that we can't fail to mention, which is cryptocurrencies such as Bitcoin, Ethereum. And these are known, or they're like to be known as good hedges against inflation. But honestly, it's a little bit unknown because they haven't been around that long. They weren't even around for the last recession. But in nature, especially cryptocurrencies such as Bitcoin, they are deflationary in nature as they have typically fixed or very limited supplies. They can't be inflated. You can't just make an unlimited amount of Bitcoin. And as the value of the dollar increases, there are more dollars out there. The supply of US dollars increases. There aren't any more Bitcoin. And so that price of Bitcoin, you can think of it as staying stable, but the price of the dollar decreases. So the relation between the two spreads apart. And so the actual value of Bitcoin related to US dollars goes up. But if you're a true believer of cryptocurrency, you can still say, 1 Bitcoin equals 1 Bitcoin. Relating to whatever, fiat currency, that's up to you. But it's by design, it is more deflationary rather than inflationary. And it's not a bad option to consider when you're thinking about protecting yourself from inflation. So, what do you do? Inflation is happening. There's no doubt about it. Again, it's a question of how transitory is it, for how long, and for how much. But inflation is here. So what do? You need to start thinking about allocating, your net worth to assets that, again, at least track but really need to outpace inflation. And there's been a lot of research done on this. We're going to post an article that the Wharton School did that really tracked different types of asset classes. And again, the top two performers in an inflationary environment are commodities followed by real estate. They're right next to each other. And so, on a normal portfolio, the classic, 60-40 stock bond portfolio that's really kind of gone to the wayside because it's just not the optimal portfolio anymore for most individuals. Obviously, consult your own financial advisor, but having some allocation to assets that are uncorrelated to public markets, such as the stock market or the bond market, can add a lot of advantages. It breeds a wide portfolio diversification, and it allows for smoothing out of returns. You're not going to see the major drops in the stock market, and you're going to achieve a higher Sharpe ratio, which is essentially a more efficient portfolio. You're getting a higher return with taking less risk. Commodities and real estate are uncorrelated or less correlated to those public markets, so you're going to have an overall safer, more diversified, smarter portfolio. Now, that doesn't mean go all into commodities, go all into real estate. That's probably not the best solution for most people, but having some sort of allocation to real estate, to commodities, I think would make a lot of sense. Again, this isn't investment advice. Consult your own advisors. This is just for your own education. I hope you've really enjoyed this video. Again, if you haven't subscribed to the channel, subscribe to the Gray Capital YouTube channel. Hop on over to grayreport.com to get the most updated research reports, news, articles, videos, podcasts from throughout the multifamily industry. And, if you haven't signed up for the Gray Report newsletter, just do it now. I guarantee you will not regret it. So hop on over to graycapitalllc.com/newsletter and you can sign up. And again, if you want to learn more about multifamily investment opportunities, you can always join the Gray Capital Investment Club. All those links are going to be below this video in the description. My name is Spencer Gray. I'm the president of Gray Capital. We're a multifamily investment and asset management firm based out of Indianapolis, Indiana, focused on, buying large apartment buildings with investors. So again, hope you really appreciate this video. Have a good one.